welcome back to this week's market update. Today is December 29th, 2023, last trading day of 2023, and you'll probably be seeing this in the new year here, but we had a great week and a great year end, so we'll jump right into this week's market update. As we closed out both the month of December as well as the year here, we'll just take a quick look at the market and how it performed this month and year to date. Here you can see as of close on Thursday, December 28th, the Nasdaq was up 6.1% on the month. The Dow was up 4.9, the S&P 500 up 4.7, and even the Barclays Ag continuing to rally 3.3% into this month. Then when we pan back and look at this year as a whole, you can see as of close on Thursday, December 28th, the Nasdaq was up the most, nearly a 45% gain, 44.2 there for the year. Outstanding year for the Nasdaq, although we are still below all-time highs there. The S&P up about 24.6%, the Dow up 13.8%, and even the Barclays Ag here up 2.5% so far this year, with one more trading day to go, not accounted for here. So one other interesting piece of context when we're looking at market performance this year, we are pretty close to those all-time highs, right? The Dow broke through their all-time high. The S&P is really close to it, very, very close to it. And then the Nasdaq is just a few more percent away from their all-time high. The index has actually only earned, about 0.4% when you account for the effect of compounding returns. So say you invested $100 January 1st, 2022, almost at the peak of the S&P 500. Then you lost 19.4% last year, bringing you down to $80. Use that $80, held it in the S&P 500 and gained another 24% this year. That would have only brought you a return of 0.4% over the last 2 years. So you would have actually outperformed the market in cash had you invested on this day. Granted, not a lot of people were investing wholeheartedly all of their money on this one day, but had you done that, you would have earned 0.4% on top of the dividend yields. Obviously, another 1.5% or so of dividends off the S&P 500. But really interesting when you just look at historical returns and how, yes, we have had a great year, but it is still needing to go higher. We'll still need some more bullishness in the new year to really get some spectacular returns had you invested in early 2022. Another really interesting aspect that I've seen this year, and more so even in the last few months and the last week or so, REITs, or real estate investment trusts, have come back quite a bit, as well as other real estate stocks. So we're looking at the Vanguard Real Estate ETF, as well as the real estate sector of the S&P 500. Both of those indexes have gained close to 10% coming up on it here this year to date, and most of those gains have been since October. So here you can see the real estate sector was kind of in a downward trajectory all year until October, when it was down 12.5%, even more than that in the Vanguard ETF. But ever since then, we've been on a quick upward trajectory, and some of this has to do with rates falling on longer term yields like treasuries, those sorts of things. And we've had quite positive performance in recent times. So really interesting stuff that the real estate market has had a fairly decent year when you look at the ending returns for this year, but just stuff we want to look at as we take a good look at the economy, at what sectors are being affected, and who's benefiting from the current macro environment. Also this week, when we pan back and kind of look at the more recent data, as we typically do in our market updates here, one of the data points this week, we got the Case-Shiller Home Price Index, and that showed an annual inflation rate of homes of about 4.8% compared to a year ago. Cities with the highest annual gains in home prices were Detroit, with over an 8% annual gain, as well as San Diego and New York, that both gained about 7% from a year ago. So, we had this brief period of deflation in home prices under this index, and now you can see the October data. We're moving towards a more moderate, typically 3 to 5% appreciation rate in the real estate market every year. So really good stuff here. A pretty stable, slow but stable housing market according to this data here. We also got durable goods orders for the month of November, and it was a surprisingly really strong month for durable goods. The expectations were about 1.5% monthly gain, and we more than tripled that at 5.4% for the month of November. This was led by a surge in demand for transportation equipment, which rose 15.3% in the month of November. So just one of the many economic data points that we look at. And this one especially looks to be more of a soft landing scenario, right? So we thought at this point, the economy would be near recession, about to tip into a recession. But it looks like when you get this strong of a month of durable goods orders, and we had a couple other really strong months this year, throughout the year actually, of really great orders here, that shows us that maybe, we're not in a dire economic environment really at this point. One final update as we close out the week and the year here is just the idea that we are having quite a strong labor market in most measures. So for the November, we saw a very low 3.7% unemployment rate. I'm sure it won't move up too much in December here. We'll get that data very soon this week. And then when we look at things like initial claims, the most recent week ending December 23rd, claims were at only 218,000 for last week. So not a lot of initial claims, unemployment is low, and the employment situation is in quite a good place as we end the year. So, thank you for watching. This will be our last update of 2023's news, and we look forward to seeing you in the new year.